All right, welcome to our course today. We're going to look at the Trump tax reform history and updates. My name is John True. I'm an attorney and a CPA. I completed an LLM degree at NYU in tax, and so that's my background. I'm currently an assistant professor at West Virginia University. I teach in the School of Business and Economics, and my teaching is, of course, in the area of taxation, both individuals and business entities and etc. And so the focus of the class today is really more on individuals and estate taxes. This Trump tax reform came through really in kind of took an interesting path to passage. It was somewhat surprising that Trump was elected in the first place, at least based on a lot of the polls and a lot of what the media and other authorities thought. And so you had somewhat maybe less than full coverage of the campaign promises of Trump. And so we're going to take a look a little bit at the history in terms of how this tax reform developed over time. It was really a group effort from Trump and a number of others. And then we're going to look at what ultimately was passed and what became the individual tax provisions. And we'll also look at the estate tax provisions. That particular section of the course is fairly quick because there just wasn't a lot in the estate tax realm. So looking at our roadmap and key concepts, we want to discuss the history of the Trump tax reforms affecting individual and estate taxation and how these reforms developed over time from the campaign through the tax reform process. Next, we want to identify the important changes to business taxation, including changes such as exemptions, pre-AGI adjustments, standard and itemized deductions, and credits and tax rates. And so these are just the individual changes we want to go through. And so if you really look at the map of individual taxation and think through, what's the formula for coming up with an individual's tax liability, we're going to work through that formula. We're going to look at the exemptions. We're going to look at pre-AGI adjustments, standard itemized deductions, and spend a little time on credits and tax rates. And so that's our focus, is to go through that way. Last, we want to provide an exposition of the estate tax law changes and implications. Really, there was very little change in the estate tax law. There were a number of proposals, from a complete repeal of the estate tax law to changing a number of things in it. And at the end of the day, there just wasn't a lot there. All they did was increase the credit, and so there just isn't a lot to discuss on estate and gift taxes. If you're familiar with the pre-2017 law, you're already familiar with the post-2017 law because, like I said, there wasn't a lot that changed there. But we are going to cover it. So the Tax Cuts and Jobs Act of 2017, we want to look at the historical background for this and talk about what were the key documents and the key indicators of where this particular act was going to go and where it came from. And our initial, the first real indication of what tax reform might look like came in June 24th, 2016 with the House Blueprint. This was an evolving document, but this is something that Paul Ryan had been working on for years. And so this wasn't entirely surprising what was in this document. A lot of this was historically there before. But the most recent real version that shaped tax policy and this reform was from this House Blueprint and dated June 24th, 2016. The next real document, and again, this one had some precursors to it, but in terms of a publication date, you have the tax reform that will make America great again. And again, that's the Trump campaign promised that promised substantial changes to corporate individual tax law. And the most recent on that, and I think the most pertinent, is the September 15th, 2016 version. This was right after Trump had won the nomination and officially been appointed. And, this was post Republican National Convention. And so this particular document is probably the best amalgamation of the promises of the Trump campaign in terms of what tax reform was supposed to look like and what they anticipated. And so this particular document had a number of interesting things. Some of the vernacular in this was interesting, and it did shape ultimate policy, so it's relevant and to understand. In a lot of these documents that Trump had published, he talks a lot about a 0% tax rate and to a tax professional or somebody familiar with taxes and the way that the individual tax rate is calculated, the concept of a 0% tax rate is kind of foreign, because even though the idea makes sense to us, we've had it beat out of us because we've learned the nuances of exemptions and credits and deductions and exclusions, and there are a bunch of different ways in which you have income that is not actually taxed. And so for us, we just don't use that vernacular of a 0% tax bracket. But Trump, speaking to his base, did. He would simplify it by just saying, look, we're going to have a 0% tax bracket. And he would use that to describe the combination of, itemized deductions, exemptions, credits, whatever he's going to do. He wanted to talk about it as a 0% tax bracket. And really, that was one of the better ways of pitching this particular idea to his base, because to the average person who doesn't understand the nuances, describing something as 0% tax bracket is a good way of doing it, because that's effectively what's actually happening. And so it was a good 50,000 foot view of what the changes he was proposing were going to do. Now, I don't know that it was necessarily characterized accurately in the sense that there was already a pre-existing 0% tax bracket, but because people didn't talk about it that way, it looked like he was bringing up a new 0% tax bracket, when in fact he was just changing the area that would be subject to 0% rates. So when we put our comparative tax rates together, we kind of, I put those tables together essentially borrowing that same vernacular and using a 0% rate. So you're going to find that. There were some other things within that tax reform that were interesting. He talked about he talked a little bit in the reform about a postcard filing. And the idea there is essentially they wanted it to be so simple to file a tax return for most people that you could do it on a postcard. And whether he actually got there with this reform or not, I don't know. We'll see what the actual form looks like that the IRS publishes. Maybe they'll try to do a postcard just as a tip of the hat. But honestly, a 1099, the simple form 1040 is already pretty simple to begin with. But he would have introduced additional simplification on that because of the removal of exemptions, and we'll talk about that a little bit later. The next key document is the spring handout, and this isn't really well named, but really all this was Trump was doing a presser in April 26, 2017, and he handed out a sort of tax plan handout to the media at that event. And so really this was just like a hard copy 1-page handout, but of course if the media gets their hands on it, they're going to publish it. And so that was the next look at what the tax reform was looking like. And it was already starting to take shape a little bit then and be changed. The next big document was the Unified Framework, and this is in September 27th, 2017. And this was important because this was the first document written by all of the interested parties together. And so Trump had a majority in the House, majority in the Senate, albeit feeble, and he, with key players in each of these decision-making bodies, drafted this unified framework. And so this, again, this is a movement from what the campaign promised to what we ultimately got, and this kind of pushed us in that direction a little bit. It was kind of interesting in that sense because we see some of the provisions going away, but some of them staying. In particular, a lot of the individual provisions stayed here, and a lot of the Trump was successful in convincing the House and the Senate leaders to come in his direction in terms of the simplification of the individual provisions, in spite of some maybe some pushback on that by special interest groups. And so you did get a unified framework put together, published in September 2017, and then they said at that time that they wanted to get this reform passed by the end of the year. So we saw that. The next data point is the House bill, which HB1, which is the Tax Cuts and Jobs Act. This was first released, the first release of the proposed bill out of committee was November 16th, 2017. And so the way the process works, of course, the House passes a bill, The Senate then needs to pass it if it passes a bill, and then they need to reconcile the two. And so the next step was the Senate bill, HB1, which was also called the Tax Cuts and Jobs Act. And this was a completed Senate version. This was on December 2nd, 2017. And then the final bill was December 22nd, 2017. Now, this final bill is technically called an Act to Provide for Reconciliation pursuant to Titles 2 and 5 of the Concurrent Resolution of the Budget for fiscal year 2018. But the law is more commonly referred to as the Tax Cuts and Jobs Act, which is what it was referred to in the original House and Senate bill. So we'll kind of refer to it that way. Or I tend to just refer to it as the Trump tax reform. But that's, when you look at it and read about it, it tends to be discussed as the Tax Cuts and Jobs Act. So one important thing, if we look at the goals of the Trump tax reform, I think that's helpful in piecing together what we ended up with in terms of actual legislation. So initially, the goals of the tax reform, and this is as stated by the Trump campaign reform plan, so September 2016 here, and these goals were tax relief for middle class Americans, simplification of the tax code, economic growth, and the fourth one was the desire that it not add to the debt and the deficit. And so this idea of it being revenue neutral was very much a theme early on. It was one of the four main goals of this tax reform back in September 2016. And so carrying forward a little bit, we then look at the spring administration tax outline. Again, this is just the handout that was given in this presser in April of 2017. And then we see grow the economy, so that's basically the same as point 3 in the prior goals. Simplify the tax code, which is, again, the same as point 2. Provide tax relief, which was an interesting one in the sense that it's less directional here. Originally it was provide relief for the middle class, and now it's just relief generally. And then additionally, point 4 is lower the business tax rate. So at this point, apparently the administration had already given up on its goal of not adding debt to the deficit, but they did add more specificity around the concept of economic growth. How are they going to achieve economic growth? And I think point 4 was the idea that look, we want to lower the business tax rate. We want to be specific about that as a goal. And if that's at the cost of adding to the debt and deficit, so be it. This is the new goal. Then in September 2017, they published another set of goals, and this was incident to the United Framework. So now we've kind of seen what the administration did on their own in September. We saw what they evolved to in April, and then in September 2017, you've now got, just before the passage of the bill, what are the goals? And these are the 5 main goals that they had at that point. And that was tax relief for the middle class families. So we now have a direction around tax relief again. It's towards middle class families. Then they had this simplification of postcard tax filing for the vast majority of Americans. Again, they want to simplify the provisions for individuals who are wage earners, who don't have a lot of income. They want the tax filing process to be very simple, and so they have this postcard concept. And it's possible that they got there. We'll see. Then 3, they want tax relief. The next goal is tax relief for businesses, especially small businesses. And this was an interesting one, and we're really more focused on individuals in this particular class, but there were some interesting provisions that were passed with respect to businesses. It's not clear to me from the reform that was passed that they effectively achieved goal number 3, but that's a discussion for another day. Then they wanted to end incentives to ship jobs, capital, and tax revenue overseas. So this is really a provision in relation to international taxation. Once again, not really the topic of our discussion here, but nonetheless one of the main goals. And I think they were a little more effective in achieving this goal with respect to the provisions that were passed in regards to territorial taxation and international provisions, but again, not the focus today. Number 5, they wanted to broaden the tax base and provide greater fairness for all Americans by closing special interest tax breaks and loopholes. There were a couple that they specifically targeted, and some of them were successful and eliminated, and others they were not. One interesting thing is part of this concept of closing loopholes and broadening the base that did manifest itself in the individual sphere was the objective of elevating the standard deduction and then eliminating a whole bunch of the itemized deductions. And that absolutely happened. And we'll talk about more specifics in that regard. But that's something that was achieved with respect to individuals. They broadened the tax base in a way by eliminating some of those, what they would refer to as loopholes, by eliminating certain deductions. And so we'll see that borne out. And that was, in fact, achieved with the ultimate tax reform in some way, in some measure. All right, so now we've talked about the goals and a little bit of the history of how this came about. Now I want to look into some of the major changes put into place. And so we're just gonna talk through a few of these things that were ultimately made their way into the tax reform. So the first one is tax brackets that we're going to discuss. The tax brackets were changed, and there was a reduction in the applicable tax rate for every tax bracket. They basically took every tax bracket and reduced them. One of the goals early on was to simplify the tax code by reducing the number of tax brackets. And that was a campaign issue. That was something that was discussed quite a bit throughout 2017 by Trump, that he indicated that he wanted to bring us down from 7 tax brackets to some number lower than 7, oftentimes 5, sometimes 3. It varied, and if you look at the different plan documents, you can see the numbers. But at the end of the day, the goal was to reduce the number of tax brackets and also reduce the tax rates. And I think what happened here is eventually, as this legislation worked its way through, and you have to do a certain amount of horse trading because every time you make a tax cut, you have to pay for it somewhere, at least to some extent. And there are trade-offs when you make cuts in one place. You end up needing to raise revenue in other places, and you have to get everybody on board. And so through a series of compromises, etc., they ultimately ended up with the exact same number of tax brackets, just with slightly lower rates. And we'll look at that in a bit. Exemptions and dependents was another thing on the chopping block. Essentially, Trump didn't like the exemptions, the framework around exemptions, where you have personal exemptions for you and your spouse, dependency exemptions for your children. And so the idea here was we want to get rid of these because they just add complexity. And then the rules for dependents are actually quite complicated. For a child that lives with a parent the entire time, that's not that complicated. But when you get into divorced children of divorced parents, and you start to get into dependent parents and dependent brothers and dependent family members, some of those dependent rules get pretty complicated. And so this was really a target of the administration to try to get rid of these, just to simplify the code. Now, of course, there is a result that happens to that where people with larger families will tend to not appreciate these changes that are put into place. And so there was some pushback on that. And some of the senators, I think Senator Mike Lee and Marco Rubio, both pushed back in terms of eliminating exemptions and having individual families that with a lot of kids being affected by that in a negative way. And so the response to that was to still eliminate the exemptions, but they increased the child tax credit. And so that was kind of the trade-off there was, well, we're still going to get rid of exemptions. We're still going to try to eliminate dependents as a important aspect of filing your taxes, and instead we're going to throw you a bone with the child tax credit by increasing it a little. So pre-AGI adjustments, these were largely unscathed. We'll talk through specifics here, but a lot of the pre-AGI adjustments survived, and so a couple of them were affected, and we'll talk about that. Itemized and standard deductions, this was probably the most significant change besides eliminating the concept of exemptions. So the itemized deductions, many of them went away, and the standard deduction was increased, and we'll talk about specifics later. Also, AMT and child tax credits were affected. The desire was to eliminate AMT entirely, and they were successful in doing this in the business context. Unfortunately, the cost of, unfortunately depending on where you sit, I guess, the cost of eliminating AMT was too great. On the revenue side, it had too big an effect on the budget. So rather than eliminate it, what happened was they essentially increased the AMT exemption amount so that it affects fewer taxpayers. And I'm sure tax preparers in general will find that a welcome change. Not everybody loves dealing with AMT. And then there's the estate tax reform, where they essentially just increase the credits. Some of the provisions that were not directly affected, filing statuses. There was a period of time where Trump talked about there being married and single filing statuses as the only ones. Then that would, of course, eliminate head of household and married filing separately. So it wasn't really clear from all the literature whether he was getting rid of head of household or not, but there seemed to be a suggestion from a lot of his preliminary things that he was essentially eliminating head of household, that filing status. Now, that was not a popular move with single mothers and single parents in general who are filing as head of household, because you get that beneficial tax status, not quite married, but also not single either. And at the end of the day, filing statuses will not change. So we still have head of household, we still have married filing separately, and of course single and married. So the filing statuses are unchanged in the new law. Most retirement plans were really largely unaffected, and so there was some discussion as to whether some of the retirement plans would be simplified. You have a lot of different types of retirement plans, IRAs, Roth IRAs, 401ks, etc. You have a lot of different provisions too with HSAs and other things with health plans. And there were some changes. There were some changes in terms of the Affordable Care Act, where the provision that requires you to buy health insurance was removed. But in terms of whether that really affects retirement plans, it just didn't have much of an impact. Capital gains taxes also. There was some discussion of eliminating the distinction between capital gains taxes and ordinary income. Really, the goal was to bring the tax rates down to the level where capital gains are taxed, but they weren't able to do that, and so that distinction didn't go away. There still are capital gains being taxed at a different rate, preferential rate. Same thing with dividends. Dividends are taxed at a preferential rate. They're not taxed at ordinary income rates. And the ordinary income rates were not brought down so low that the distinction doesn't matter. Accounting methods are essentially unaffected. Filing deadlines didn't change. The overall concepts for income recognition all remain the same, so there weren't really a lot of changes in terms of that, and so that does affect a lot as a tax preparer in terms of how you do your job. A lot of those things are just the same as they ever were. Also, almost everything in the individual taxation world after 2025 is due to sunset, and so all of the reform provisions, well, substantially all of them that were passed under the Trump tax reform, sunset after 2025. Some of them sunset before that, but basically everything sunsets after 2025. Meaning, after 2025 in tax year 2026, if no changes are made to the tax law between now and then, we will return back to 2017 tax law. And so you can't really forget everything you learned about exemptions and dependents and all these things that are going to go away. You can't forget about the special itemized deductions that happen to be embedded in the Schedule A in 2017 that go away in 2018, because you don't know if they're going to come back or not. And so I guess post them away in your memory bank somewhere, because you might see them again. So let's look at tax brackets. 2017 and 2018 tax brackets compared. And of course, you could star the 2017 tax brackets and say these are going to be the 2026 tax brackets again, assuming Congress doesn't do anything. But that's certainly not clear at this point in terms of what is likely to occur that far out in the future. So let's look at this. We've got tax rates, and of course, in this case, we've set a 0% tax rate. And if you see the 0% tax rate, that's $0 to $10,000 for single, $0 to $21,000 for married filing jointly. The reason we've done this again is we're basically just taking the exemption amount, personal exemption amounts plus the standard deduction, and saying that's a 0% tax bracket. That was Trump's way of describing it. And so when you look across the board, you see that the 0% tax bracket did increase. It wasn't a huge increase though. So this 0 to 10,000 for single individuals before became 0 to 12,000. And the way that happened is you got rid of the personal exemption and you added in a higher standard deduction. So there was an increase in the 0% bracket for most people. It just wasn't a tremendous increase. For married filing jointlies, from 0 to 21, and now it's 0 to 24. So the 0% bracket, again, slight increase in it, but not tremendous. Then you've got this 10% bracket, which now applies at higher income rates. You see the 15% bracket was changed to 12%, 25 was dropped to 22, 28 was dropped to 24, 33 to 32, and so on and so forth. Now, it looks like the 35% brackets are the same, but they're actually not, because they cover different ranges of income. And so there actually were some changes there that are somewhat interesting. And then the 36% bracket, the 39.6% bracket was dropped to 37%, and the income was increased to where you hit that bracket. So overall, this represents an across-the-board cut in the tax rates for assuming you hold the taxable income constant. Next, we're going to look at exemptions and dependents, and this is probably the biggest change for individuals, the biggest change individuals will notice. In the past, we always had to record all of our dependents on page 1, and then you got so many exemptions depending on how many dependents you had. Well, the personal exemption and dependency exemptions, which are $4,100 each, were eliminated in exchange for increasing standard deduction, which are both part of the tax code simplification process. Now, for an individual who itemizes, this is not a welcome change. And so a lot of your middle class clients that are itemizing their deductions because they own their homes, this is not a good thing, because now you're trading an exemption that you get even when you itemize for a larger standard deduction that you don't use anyway. I will say, though, this does present the opportunity, because the standard deduction was increased so much, for taxpayers to use bunching. And the concept of bunching is essentially that if you can control when your itemized deduction expenses occur, then you can bunch them into years and then come out better off overall. So hypothetically, like if you're making a charitable contribution, which is one of the itemized deductions that survived, and you typically donate a certain percentage of your income to a church every year, and we'll just use the tithing example, which is usually 10%. So if in each year you typically give 10% tithing to your church, one thing you can consider doing is giving 20% in the first year and then not paying in the second year and then doing 20% in the third. And so you basically bunch those donations together. And if you do that, that will increase your itemized deductions quite a bit and then decrease them in the second year, and then you rely on the standard deduction. And so when you net those two things out, you may end up with a better tax result across the board. So that's one of the things that clients might do to plan for that. But at the end of the day, people who itemize probably aren't going to be very happy about this change. There is an increase to the child tax credit, though. So if you're talking about somebody with a lot of children, then you just have to run the numbers and see whether they're better off or not. But a married couple that itemizes is probably not going to be happy about that particular change. Dependents. Many of the complicated rules for dependents are no longer as relevant, but determining a dependent still matters for purposes of the child tax credit. So I think the non-child dependency provisions just aren't as relevant anymore as they used to be, because you don't use those to determine exemptions. And so a lot of the more complicated rules that applied to everyday individuals are basically going away. And so that's one significant change that's affecting taxpayers and tax preparers. So now let's look at pre-AGI adjustments. First, there's a number of pre-AGI adjustments that were unaffected, but we're going to look at the ones that. So we'll just go through each of these. There's really no change to the educator expenses, and this permits educators to take a $250 pre-AGI adjustment for spending personal funds on classroom supplies. And I talk about them as pre-AGI adjustments. Some people like to refer to these as above the line deductions. Other people refer to them as for AGI deductions. So there's a number of ways you talk about it, but we're just talking about things, the deductions you get before you determine your AGI. So educate your expenses survive. HSAs, qualified plans, and IRA deductions, there were no changes to these provisions, and so these are treated the same as they were under prior law. Alimony was one of the ones that really did see a significant change. Prior law treated alimony payments as deductible to the payer, so the person who's paying alimony got to deduct them, and taxable to the recipient of the alimony. The tax reform eliminated this pre-AGI adjustment, and so for a divorce commenced after December 31st, 2018, alimony is not deductible to the payer, nor will it be income to the recipient. Now, in theory, this sounds like a good thing. If you have like a traditional family with one spouse working and one spouse who's providing caregiving in the home and not working, they get divorced. The working spouse is then paying alimony to kind of even out their lifestyles. And it sounds like it would be good now because you're not going to make that spouse that doesn't have income have to claim a bunch of income on his or her tax return. But the reality is that's usually not a good result because the person paying the alimony tends to be in a higher tax bracket. And so if you're looking at the couple as a whole, will the couple be better off in terms of their tax obligations by this rule? And the answer is no. Usually the couples are actually going to be worse off looking at them as a whole because the payer now is going to continue to keep that income in the higher tax bracket. Presumably they'll be in a higher tax bracket, otherwise why are they paying alimony? And then the recipient, who would be in a very low tax bracket, may be able to qualify for earned income credits if they receive this income. Actually, it's not earned income, so that's probably not going to affect them. But if they're receiving this income, they're going to be taxed at a much lower bracket if they don't have other income in addition to it. And so net, this is actually a tax gain for the government and a tax loss for divorced couples. Now, they don't really necessarily look at themselves as divorced. They don't necessarily look at themselves as a unit as a whole, but there is a certain amount of bargaining that goes on in terms of calculating the alimony amount. And I think tax considerations probably go into that. I assume they do, at least from a well-counseled individual, then they'll take tax considerations into account. And so this might make divorces a little bit stickier in terms of determining alimony amounts. Certainly, individuals that have to pay alimony may be a little bit less willing to do so and agree to as high alimony rates when the tax considerations are not as favorable. And from the recipient side as well, they would have been paying a low tax on that alimony that they were receiving. Now they don't pay tax on it at all, so that's good for the recipients in terms of simplification, but it's not a good thing if the payer then is going to reduce the amount that they would otherwise pay. And assuming people are rational, which probably is an overbroad assumption for a couple in the process of a divorce, but if we assume rationality, then we can assume that alimony payments will actually go down probably for alimony payment recipients, but we'll see how that plays out. Moving expense deduction, this one goes away. So the moving expense deduction essentially allowed individuals to take a pre-AGI adjustment for moving expenses as long as they're relocated to an office that was in a new area. And there was a 50-mile rule and a bunch of other rules around that pre-AGI adjustment, and this moving expense has been killed. So you no longer get a deduction when you relocate on a pre-AGI basis. So now let's look at standard and itemized deductions. The standard deduction changes are pretty straightforward, but of course they have far-reaching consequences. The increased standard deduction for single filers went from $12,000 to $24,000. It went to $12,000 for single filers and $24,000 for married filing jointly filers. And this sounds like a huge increase, but when you take into account the elimination of the exemptions, this isn't really that big of a difference. So essentially, before, when you were single, your standard deduction combined with your exemption was about $10,000 anyway, so this is going up from 10 to 12 when you look at it that way. But if you're looking just at the standard deduction in isolation, this is a big jump. It's basically doubling the standard deduction. So itemized deductions saw a number of changes as well. This was part of the broadening the base concept and closing loopholes. So quite a number of changes. So first, the state and local tax deduction is capped at $10,000. That's a pretty significant change for individuals in high income tax states. And really, even individuals in low income tax states, this isn't an insignificant change, because if you're looking at state and local taxes, included in that is property taxes. And your property taxes for a home could be well in excess of the $10,000, even if you're in a state that doesn't have any income tax. And so this has been criticized as an elimination of a deduction or a restriction on a deduction that really affected blue states. And that's true, because they're affected more by this limitation than individuals in red states. But to suggest that only blue state individuals are affected is not true. So individuals in, like I said, in states that have no tax whatsoever at the state level are still going to be affected because of the local tax deduction. Like I said, this includes real estate taxes, state income taxes, and state sales taxes. And so, again, not a favorable result for most individuals that itemize deductions that own homes, but nonetheless the case. Medical expense deductions were increased, and this is kind of interesting. It was interesting in the sense that the medical expense deduction was on the chopping block, and so through the negotiations, not only did this particular deduction survive, but the AGI limitation was reduced, which means this deduction was given even more, this was given strength. So they strengthened this deduction. So now if your AGI is $100,000, your medical expense deduction only kicks in after you've incurred $10,000 in medical expenses. Well, under the new law, effective in 2018, now that's $7,500 in that particular setting. So you basically get to take more of your medical expenses against your tax as an itemized deduction. Now, this is going to affect mostly elderly individuals elderly individuals tend to have higher medical expenses, and so this was something that I'm sure was lobbied for by those groups. The charitable donation deduction, interestingly enough, was increased. So the AGI limit was increased to 60%. And I think the reason they did this, I can think of a couple of reasons. First, so they strengthened this deduction. The prior limitation was 50%. They've now increased it up to 60%. And so in theory, you can take, not in theory, but in practice, you can take larger deductions for charitable contributions. Now, it's not really been my experience that a lot of my taxpayers tend to hit that limit. But when that limit tends to get hit, it's when they make large donations. Like oftentimes I'll have a taxpayer that's a little older, doesn't need the money that they have as much for their own support, and so they might give a piece of property to a charity. And in that instance, the piece of property may be worth a lot more than their annual income, especially if they're retired and they're really only taking withdrawals from their minimum required withdrawals from their retirement plans. They may not even have that much income. So in that event, oftentimes they'll hit that charitable deduction max. And so increasing that to 60% is going to let them take a little bit more of a deduction against their retirement income. My younger taxpayers just don't tend to hit the max anyway. And I'm not exactly sure how common it is to be limited in your charitable deductions by this AGI limit. But I think what they were going for here was there was a concern that by elevating the standard deduction, a lot of charities were going to be adversely affected, because in theory, if people no longer itemize, donating no longer gives them a deduction. And so there was a concern there that essentially this increase to the standard deduction was going to adversely affect charitable entities. And there were a number of charitable entities and educational entities that were concerned about that. And so I think this was a way to throw a bone to those groups to kind of get them on board to say, look, we aren't trying to kill the charitable donation deduction, and in fact we're even going to strengthen it for your high dollar donors, but we still want to do what we want to do to simplify the tax code. And so I think this was kind of one of the trade-offs that came out of the compromise, and really nothing in the prior literature suggested that they were planning on increasing this amount. I do think this was just something to do at the 11th hour to get this provision through, so that public charities would support it. Then you have the mortgage interest deduction that was changed. They just made a couple of changes to it. Essentially, in the past, you could only take mortgage interest. It was only deductible on the first $1 million of property that you purchased, and they've reduced that amount. So now it's only up to $750,000. So if you buy a home and you borrow $750,000 to purchase that home, you can still deduct all of your mortgage interest. If you go over $750,000 on a new purchase of a home, then only the interest on the first $750,000 is deductible. So that's the change, and that mirrors the prior rule. The prior rule, the limit was $1 million, so it's no different than the prior rule, except that the level's lower. There also was a change with respect to second mortgages. In the past, you were permitted to deduct second mortgages. I won't go into all the specifics on that, but when you took out a second mortgage loan on your home, the interest on that was deductible as well, as long as it was a home equity loan, and there were a couple of other provisions that applied. Well, now the rules for that have tightened up. So now second mortgages, they have to be under the $750,000 limit, just like first mortgages, and they also have to be acquisition indebtedness. So the way you have acquisition indebtedness with a second mortgage basically is when you take out a second mortgage to make an improvement on your home. So if that's the case, then you're still okay to deduct it. It's treated similarly to the first mortgage. But if you take a second mortgage to go on a trip, or you take out a second mortgage to pay for your kid's college or something like that, you're no longer going to be able to deduct that. And so there's a limitation on that, where acquisition indebtedness is required for a second mortgage to be deductible. So those are some changes to the mortgage interest deduction. Probably not going to affect too many people. It's on new acquisitions, and I think for the most part that's not going to make a huge difference, but it will trim down that deduction for your high wealth clients, individuals with homes that are worth more than $750,000. That's going to be an issue. So again, these are just the topics that I said. Interest deductible only on the first $750,000, and the second mortgage is not deductible unless used to make improvement or addition to the home. Now, the biggest change, I think, to the itemized deductions was that they eliminated the 2% AGI floor deductions. Now, there are a number of these, and I'm not going to list all of them, but you had basically the big ones were unreimbursed employee expenses, tax preparation fees, and miscellaneous deductions. So these were subject to a 2% AGI floor, so you had to have more than 2%. These deductions had to exceed 2% of your AGI in order to be taken, so a lot of times you didn't end up taking these in the first place, but these have all gone away. And then also the casualty loss deduction has been eliminated as well. So casualty loss, common deduction, it's commonly actually tested on a lot of like the CPA exam and other things. Now, how often do you have clients with casualty losses? I guess it depends on where you live, but it's not necessarily a deduction that people are relying on or planning on. And so it seemed like a ripe deduction for eliminating, because not too many people were going to complain. And so they got rid of this. And they will pick up some revenues at the federal government based off this elimination. Now, there is one exception that they still permit for certain federal disaster areas. They can still get relief. And so that's still something that's going to be out there. But in a general sense, the casualty loss deduction's gone away. So now we want to look at the child tax credit, or a number of changes to this credit. And essentially, the motivation for these changes was that when they were looking at eliminating the exemptions, some of the constituencies with a lot of children, like the state of Utah and Senator Mike Lee, were really concerned about eliminating exemptions, because if you have a family with 4 to 6 children, that's quite a bit of increase to your 0% bracket, if you think of it that way. And so there was some concern that, hey, we can't do this because then the large families are going to be punished by eliminating exemptions. and individuals with a lot of dependents are going to be paying more in tax. And is that really what we want to do? And because a lot of those are voters for Republicans holding offices, they wanted to find some way of protecting or at least throwing a bone to those individuals. And so this is what I call the large family benefit credit. And so the child tax credit was expanded. A couple of the details: it was increased to as much as $2,000 per qualifying child instead of just over $1,000. And also the refundable portion of the credit was increased to $1,400. Now, we talk about a refundable portion, and this is somewhat deceptive because when we think of tax refunds, of course, a refund is just getting back what you've paid. But when we say a refundable credit, what we mean is like the earned income credit, where you can actually be paid not just a refund of the taxes that you've already been received, but they use the term refund to suggest that you can get money out that you never paid in taxes. So you can get all of your taxes back plus get this refundable portion. And that's fairly well understood by tax practitioners, but it's good to clarify anyway. So the refundable portion of the credit increased to $1,400. So this means that an individual can get all their taxes back plus $1,400 per child because it's refundable if assuming it applies and they meet all the rules. They also eliminated the additional child tax credit, and that was previously used to calculate this refundable portion of the credit. The new law essentially collapses the two credits into one, which makes sense because the rules are basically the same for both credits. And instead what they do is they say that the new law essentially says that the refundable portion is subject to these particular additional rules. And that's really what they were doing essentially in spirit before is what they're doing now. It's just now we don't have the additional child tax credit and the child tax credit. We just have the child tax credit. And by the way, it may or may not be refundable depending on your circumstances. Now let's look at estate tax changes. And this is the last thing we're really going to focus on in this class today. And the changes in 2018 are that the exclusion amount of the estate tax was doubled from $5.49 million in 2017 to $11.2 million in 2018. Remember, the exclusion amount, this is the amount of property or money that can be given through an estate without incurring any estate tax liability, because it's essentially exempt. Your first $5.49 million in money you give away to somebody other than your spouse is exempt from estate tax. But you also have an unlimited marital exclusion, so you can give as much money to your spouse as you want without being subject to estate tax. And so using the credit you have as well as the credit your spouse has together, you could already get $11.2 million out of your estate without paying taxes on it. Now, with this exclusion increasing to $11.2 million, when you have a married couple, they can actually give away $22 million at death without incurring any estate tax. So you've really doubled the amount that you can give away without incurring estate taxes. And I mean, the significant majority of Americans are not going to have estates in excess of $22 million. And so this basically, it's a sort of repeal of the estate tax because you've increased this exclusion so high that most people just aren't going to be affected by the estate taxes at all. It's going to become much more rare that anybody is going to fall in this particular provision because not that many people have over $10 million in assets. And so in terms of planning for the estate tax, it was already, you already had to have over 5.5 million to really need to consider planning that much. Now that it's up over 10 million, you just need to have high wealth clients before they need to be concerned about estate taxes. Now, I will say that over the lifetime of your clients, their wealth grows and tends to, especially if they're high income earners and they're investing their money well. And so they still, just because somebody may have an estate of only 2, 3, 4 million, that doesn't mean they can't get to 22 million by the time they hit death. So they still need to get advice and counsel on taxes. But the reality is the significant majority of individuals will not have 22 million between a married couple by the time they die. So there is this issue of portability, however. So portability is the ability to stack these exclusions. So let's suppose that you have two individuals and the first individual passes away. They're a married couple, so we'll say the husband dies first because that's usually what happens with, at least based off actuarial charts. And so husband passes away, and the couple together have, we'll say, $15 million. And husband gives all of his assets to his wife, so he doesn't incur any tax, and there's a marital exclusion that allows him to do so. And then that money goes to the spouse. And then the spouse dies, and she has $15 million in her estate that goes to their children. At that point, her exclusion amount's $11.2 million, and his exclusion amount was $11.2 million. So with portability, she's going to be able to exclude the entire $15 million. However, there is a catch. In order to benefit from portability, she's going to need to file an estate tax return when he dies, electing to give the unused exclusion to the surviving spouse. And so that's an interesting area because there is something that needs to be done for that portability to happen. It is not automatic. And so it is really important, even though it looks like these estate tax changes mean that it's less and less likely that your clients are going to need to file tax returns. You still need to file that initial return just to elect for the surviving spouse to get the portability, to get that unused exclusion amount. And I've actually seen or heard of cases where the personal representative for the estate wasn't really favorable or wasn't really friendly with the surviving spouse. And this often happens with second spouses. So you can imagine an elderly individual who remarries in their older age and wants to give the assets to the surviving spouse, and the surviving spouse is not the parent of the kids who are administering the estate. And if the children are administering the estate, and perhaps the estate's giving some money to the kids and some money to the surviving spouse, well, the surviving spouse wants that executor to file a return and give that exclusion to the surviving spouse. Now, it doesn't do the executor any good not to file that, but I have seen that withheld by individuals who essentially just said, you know what, we don't really like you, so we're not going to do that. And if you want us to do that, then you're going to have to pay for it. And so we want you to pay for all the legal fees of the estate out of your money from the estate if we're going to file this return. And there's been some litigation over that and some fights over it, but most of these I've seen have gone through and they've settled out and just said, you know what, fine, here's an extra $50,000. Please give us this exclusion. And they work out a deal. I think in the future there may be cases that say that there's a fiduciary duty to file this exclusion, since there isn't any loss and it benefits the beneficiaries of the estate. And I would suspect a court would force that to happen, but it's a little tricky when you have to force somebody who may not otherwise need to even file a tax return to do so. And so it's an interesting area of the law. It's worth being aware of with respect to portability and exclusions. But by and large, the estate tax provisions in general are going to have a lot less impact on clients over time because of this significant increase in the exclusion amount. So this wraps up our class for this section 1 of the class that goes over individuals and estate tax differences. A lot of interesting changes, and this is just a quick summary of them, but this gives you at a high level an understanding of how things are changing. So I appreciate you joining the class today, and I hope this section of the class was helpful to you.